Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets.
I'm Joann Spadigam, European rate strategist, and I'm joined today by Paul Robson, our UK macro strategist, and Deepika Dayal, our US economist. It's been a pretty interesting week in markets where US and China trade tensions have really helped the market and helped risk sentiment over this week. Fund ends have moved higher, equity markets as well, and spreads have performed. We also had a pretty big UK and US data week this week, so maybe we'll start there. Paul, UK data has really been a focus for this week. Do we have some good news here?
Yeah, I think so on balance. I think the key takeaway from both the GDP report and the labour market report is there was very little support or supporting evidence for the idea that the Bank of England needs to loosen policy more quickly than maybe a sort of gradual pace. And I think that's important because the market has been really quite dovishly priced over the last couple of months. We're having quite a big repricing. Some of that's obviously going to be events outside of the UK, but the data I think were important in that context. So the Bank of England continues to cut rates, but a little bit more slowly. In terms of the GDP numbers for the first quarter of the year, they were 0.7 on the quarter. I think that's reasonable. I think that's going to be the strongest of the major nations, the G7, given the UK's relatively poor growth performance in recent years. In your words, good news, I think. The contributions were a little bit puzzling. You had this really good performance by investment business investment. It'll be interesting to see whether that persists into coming quarters. We doubt that. And then also you had quite a good performance of exports, but we know that tariffs have been a focus and people maybe have pre-ordered to get ahead of tariffs. And I think the sort of less good news, if you like, is that we think that this is the high watermark for growth for this year. The growth outlook is more challenging through the rest of the year. You've obviously got to negotiate the national insurance contribution increase, the impact of the national minimum wage. And of course, you've still got this de facto tightening of monetary policy in the UK as people refinance their mortgages, and that's going to be a headwind. And even though maybe the international environment has got a little bit better over the last couple of weeks, it still remains challenging. So a quick normalization in growth, I think, should be expected. And it was a similar story from the labour market. I think a little bit better than the official consensus. I think here we may be moving through the point of peak job shedding. So it's sort of between March and April around the national insurance contribution increase, and once we get through there, we still think we're going to get weaker employment, but maybe the worst is behind us. And again, maybe that's some good news, as you said.
So we've also been a bit more on the hawkish side of central bank expectations, particularly in the UK. How do you see front-end pricing now, post the data and post the US-China agreement from this weekend?
Yeah, it's really hard to disagree with what markets have now got priced in. As I mentioned earlier, they were really quite dovishly priced. Before coming into record today's podcast, I think we had 45 basis points of easing priced by the end of the year. We've got 57 basis points of easing over the coming year. And that's pretty much what our base case is. We've got 50 basis points on both those. So 2 quarter point cuts through the rest of the year, get to a terminal rate of 3.75. So that's pretty much fair, I think. And we do have inflation data next week, and I think that's going to be important. I still think for the Bank of England outlook, it's really about what employment's going to do over the coming few months and quarters. And if employment was to fall more quickly, then we would expect the Bank of England to ease a little bit more quickly. But we'll watch those inflation numbers, but we're pretty comfortable with the idea of a gradual easing of monetary policy. And at the moment, markets agree with us.
Just to wrap things up on the UK, how are you seeing long end rates at the moment, given what we've seen in front end pricing for this week?
Yeah, so the outlook for the long end part of the curve, it still remains challenging. Fiscal policy still is challenging in terms of supply and demand dynamics. The supply outlook for the UK hasn't changed because of that data. It's going to be relentless through the whole of the year, and it's really just focusing on the demand side. And over the last year or so, overseas demand has been quite critical. They're price sensitive. And one of the key things I think we need to focus on is this just general demand for duration and that supply. And of course, lots of other economies are loosening fiscal policy at the time when the UK is issuing. So it still remains challenging. But now we are roughly around our long-term, well, our fair value estimate of 475. And so the risks around that, I think, have become more balanced. I think when we were lower in yield, the risks were definitely skewed higher, but now we're at those levels. We do have a 30-year syndication next week. That's going to be, I think, the focus for the week ahead. I think that will go okay. I think pretty cheap on asset swaps. The DMO is significantly reducing the supply of long end gilts. So for those who want to get access to that, then this is an opportunity. So I'm not expecting that syndication to really impact the long end. And we stay around here watching other markets, most obviously the US, I think.
Thanks, Paul. So I think maybe now let's move over to talking a little bit about the US. We did get a set of inflation numbers this week, and obviously the developments over the weekend have also shifted Fed pricing quite a lot. How does this impact your inflation forecast, and how does the numbers from the CPI print this week as well feed into that?
You're right, Joann. It's been a fairly exciting week. We had a busy economic calendar to begin with, and the development on trade talks over the weekend also sort of added to that excitement. There was a little bit of de-escalation between US and China trade talks over the weekend, so much so that the rate on imports from China from a US perspective are now down to about 30%. Versus 145 that we had prior to the weekend. So, excluding the fact that, taking into account the fact that there is no tariff on communication products, there were tariffs in place on iron steel products and autos even prior to the weekend. With this 30% number that we have over the next 3 months or so, while US and China try to get to a more amicable arrangement, that puts the overall tariff rate on Chinese imports closer to about 25% or so. And that has also brought down the overall tariff rate that the US would be charging from its other trading partners from about 25% prior to the weekend to about 11.5%. I mean, there are estimates that are going around, but it's in the same ballpark of about 11 to 14% or so. So with that reduced tariff rate, of course, that sort of improves the inflation outlook. However, we still think that the improvement will not be enough for the inflation numbers to start moving back again towards the Fed's 2% objective. So prior to these de-escalation talks, we were looking for core PCE inflation to sort of climb up to about 3.5% by the end of this year. We're still looking for inflation to start climbing in the second half as we start seeing the impact from tariffs beginning to feed through to core goods prices. But we're now looking for a slightly smaller inflationary impetus from tariffs. We're looking for core PC inflation to rise around 2.93% by the end of this year. But that would still be away from the Fed's own objective of 2%. Of course, this week's inflation numbers could add some skepticism to that thought. We saw CPI come in a touch softer. The PPI this morning, as we record on Thursday, that was also softer than expected. And neither of the reports showed any impact from tariffs at this point. Of course, heading into these reports, we weren't looking for much of an impact just yet. The tariffs were really announced in April, and given how well massaged supply chains are at this point, and the typical lead lag relationship between higher import prices and consumer prices, what you and I end up paying ultimately, we do think that inflation prints will start looking firmer in the second half of the year. So, if anything, this morning's numbers and the CPI numbers that we got could be calm before the storm. And it would be a good calm before the storm. If we look at the implications from these reports for the core PCE deflator, which is the Fed's preferred inflation gauge, which is we're looking for a flat reading on the month for that number, which hasn't happened, I believe, in about 7 months or so. And that would push down the year on year rate to 2.4% or so. So, without the trade policy outlook interweaved into these inflation numbers, this week's inflation reports would have been something to cheer for the Fed. However, as we've heard from many Fed officials over the course of this week, it is too early to cheer, and there is a definite potential for inflation numbers to start firming up once again over the course of the second half. So, with that in mind, while we are expecting a smaller inflationary impetus from these latest round of de-escalations between US and China, we're still looking for inflation to start climbing over the remainder of the year, and as I noted, to rise to about 3% by the end of this year on a quarter to quarter Q4 over Q4 basis in 2025, and extend into Q1 next year.
So other growth-related data has also been released this week. Along with the inflation outlook that we see now, how are you seeing the Fed going forward? Of course, we've had a much more off consensus view than before, but it really does seem like the market is coming on side with your views at the moment.
Well, yes, I think it has been a little helpful. We about 3 months back or so, we changed our Fed call to no cuts for this year. And we maintain that call even after these developments on the inflation stuff and the growth data this morning that we got, or even earlier in the week, sort of supports the idea that with these developments, the Fed may be a little closer to its objectives, but it's still far away from its objectives. So much so that they would continue to focus on trying to estimate where the deviation will be. The baseline, we believe, remains that the Fed will not be moving towards its objectives, its dual mandate objectives this year, neither on the labor market front nor on the inflation front. From what we know on the growth data this morning, retail sales were a touch softer than expected, but given the strong statistical platform that they will have from the strength in Q1, where it seems like consumers were front running a lot of their purchases ahead of the tariffs, it feels like we could still have a 3% handle on personal consumption in Q2. And that would imply growth remains strong through the first half of the year, which shouldn't nudge the Fed to move towards further rate cuts. Of course, we could still see some slowing over the course of the second half, given how much uncertainty we've had over the last few months or so. And that that will begin to weigh on this sort of hard data at some point. We just think we're not there yet. And with inflation still being benign and there being a certain level of uncertainty to the inflation outlook, we think the Fed can remain patient. So, moving on to Europe, Joann. European rates have repriced significantly on the back of US trade news. Do you think that's right?
Yeah, so I think that, of course, as we saw at Liberation Day, was a real reason for us to see rates rallying in the front end in Europe as well. And that's clearly because that 20% tariff was quite high. We've been a bit skeptical about, how that translates into European growth, but it seems like the positive news from this week has really been that trade negotiations between the US and China have moved in a fairly positive direction, which clearly could have some implications for how trade deals go with the euro area as well as other trading partners. So I think that the move higher in front end rates this week has been essentially in line with that idea that we don't really get a 20% tariff for Europe and perhaps get something a little bit lower. I also think that overall we are quite positive on the growth outlook in Europe based on the fact that firstly, we don't really think that 10% tariffs on Europe, for example, should have a meaningful or significant impact on European growth. Markets are pricing in around, I would say, 180, 175, 180 for terminal rates for this year. And that's around 25 basis points higher than where we are at the end of last week. And yes, I do think that is correct. I mean, I think that for Europe, there is a very different set of risks versus the UK and the US. Inflationary risks are pretty muted in the euro area. And I think while growth risks are skewed to the downside, that peak pessimism that we had with tariffs has faded to some extent. Our base case does remain for the ECB to take front end rates to 2%, so terminal rates to 2% this year. And obviously markets are a little bit below that, but I do think that it would be misleading for the ECB to give us any clear guidance in the June meeting to suggest that they've decided to stop cutting rates, right? I think central banks will retain optionality, and so with growth risks to the downside, I think it will make sense for markets to at least price in some risk of additional easing through the year. And whilst uncertainty remains high, I think that rates will remain slightly below our 2% target for now for terminal rates.
Okay. So within Europe, German defense headlines have been circling once again this week. What do you make of these, and how do you think risks are skewed?
So, I mean, I think in terms of the long end, German defense spending has been a topic that the market was quite interested in before the trade tensions took over. There was a headline, a little bit misleading, I would say, that 5% would be where defense spending in Europe, in Germany specifically, was heading. And actually reading into that, it wasn't really saying that they would be spending 5% just on defense, but rather a mix of defense and infrastructure, which I think is in line with what we've seen in the past. I think for now, we just need to wait for more clarity from the German budget and the German government on what exactly they want to do in terms of spending. The 2025 budget is still being discussed. We could get some more information by 25th of June. But again, I think still the timeline for this is quite hazy at the moment. I think what is more clear to me, though, is that there is a upside risk for supply going into the second half of this year and into next year, just given the size of fiscal spending and fiscal space that Germany has following the shift in the debt brake rule a few weeks ago. So I think when I'm thinking about risks, to the front end, to me, the risk is still to the downside if trade risks materialize. But thinking about the long end, it seems to me that fiscal policy and spending are really going to be front and center for the long end of the curve. So I do think that there's some room for the long end to rates to move higher, even in this environment and at this stage. But that's it for me. Thank you all for listening in on our podcast this week. We look forward to another interesting week in markets next week with a lot of data due, particularly UK inflation. If you did like this episode, please don't forget to follow and like.